Okay, right. Welcome everybody, and thanks for joining today's Healthcare Markets International webinar on the application of sustainable finance to the healthcare sector. I'm Nick Herbert, and I'm the editor of Healthcare Markets International, which, if you've not seen it before, is available on trial at the moment. Fittingly, the April issue of the monthly journal is focused on ESG, both in terms of the finance market, but also its impact on the pharma industry and German real estate, of all things. Okay, today's event will run for about an hour, during which time there will be opportunities for you to ask questions of the panel via the chat function. So please feel free to get involved. There's plenty of questions to be asked, I'm sure. Okay, before I introduce today's panel of experts, I'd just like to thank Bevan Brittan for partnering us on this exercise. And I'd also like to take the opportunity to say a few words to put today's conversation in context. Now, there can be no doubt as to the difficulties we face in addressing climate change and in creating a sustainable planet. The latest Intergovernmental Panel on Climate Change report, published earlier this year, says that human-induced climate change is causing dangerous and widespread disruption in nature and affecting the lives of billions of people around the world. The scientific evidence is unequivocal. Climate change is a threat to human well-being and the health of the planet. Climate-related illnesses, premature deaths, and the threats to mental health and well-being are increasing, and the effects are being felt most acutely among lower income populations. And this is before we even look at the demographic changes that we have to cope with and the impact of the COVID pandemic on our health and well-being. It just goes to show the growing importance of focusing on the S and G and not just the E of ESG. Now, perhaps the healthcare and life science industry does not face the biggest of challenges in addressing greenhouse gas emissions. There are obvious areas that can be and are being addressed, such as in construction of care homes and addressing Scope 1 and Scope 2 greenhouse gas emissions. But the healthcare sector is ideally placed to satisfy some of the social issues we face in building an equitable and healthy future. It sits firmly in Goal 3 of the UN Sustainable Development Goals, and the UN member states have signed up to ensure health and well-being for all and at every stage of life. What we learned during the pandemic, however, is that we need to improve the healthcare infrastructure in order to provide access to affordable healthcare to all when it really matters. But who's going to pay for it? Governments have plenty of other demands for their funds, so it needs to come from private capital. In other words, us through pensions and savings. Now, luckily, there's never been more capital flowing around and never more capital tilted towards addressing ESG. And the green bond market has shown that it's possible to direct funds into sustainable projects like wind farms and other renewable energy projects. The same is true with social bonds, a vehicle through which billions of dollars were raised during the pandemic to support health systems and the job market. More and more ethically driven funds are being added to the pool of private capital as consumers, governments and regulators join the journey to net zero and a just economy. But what do healthcare companies need to do to attract the wave of funds looking to help finance efforts to cut greenhouse gas emissions and do something really positive and ambitious for the world's well-being? It's not just a purely altruistic exercise either. Research shows companies that adopt a credible position towards ESG register a better share performance, have a more engaged and motivated workforce, better PR, they don't come under pressure from activists at AGMs, and cheaper funding. What could be better? Healthcare companies have been rather late to the game in tapping into the green and social bond markets at just 0.3% of total volumes in both categories, but they have been more active in the newer sustainability-linked bond and loan markets, representing 7.4 and 4.6% of total volume respectively. And perhaps sustainability-linked structures are more suitable for firms in this sector, but the market is new and there are issues that need to be resolved before it becomes truly mainstream, and we'll be looking at some of those issues later. Now, healthcare is already doing a good job and perhaps should shout more loudly and widely as to its achievements. But there's more to do, as we all know. Attracting a greater share of the world's ethical investment funds will help finance the industry's aspirations. So let's find out how healthcare companies and investors are adapting to the new paradigm. And I'll be introducing our panel of experts as we enter the discussion. So first off, I'd like to introduce Deborah.
Thank you, Nick. Good morning, everyone. I'm Deborah Roundtree. I'm a banking and finance partner at Bevan Brittan, and I specialise in healthcare finance. So I work as part of our large multidisciplinary healthcare specialist team of lawyers at Bevan Brittan, and I advise banks, private equity funds and other investors providing funding into the sector, as well as acting for operators, developers, and health and social care providers who are taking on funding. I think it's really great that we're talking about ESG funding for this sector, which as Nick has mentioned, is really well placed to demonstrate ESG credentials. I know over the last couple of years, I have seen, and the financial markets as a whole have seen a real increase in ESG funding products, be that sort of green or social bonds and loans, which are, providing funding for a particular ESG purpose, or sustainability linked products where there are targets linked to ESG credentials. And whilst it's fair to say that the healthcare sector probably has been a bit slower to bring this on board, and I think there are probably good reasons for that. It's certainly an area that's being talked about a lot more in the sector, and that I know from speaking to my funder and investor clients is becoming a real area of focus for them. I can see that in term sheets that are coming across my desk. They increasingly now do have ESG requirements within them. So I'm really looking forward to the discussion today and to hearing from my fellow panelists. And I'll now pass over to Torsten.
Yes, Torsten. Thank you, Deborah. Torsten, over to you.
Great, thank you very much, Nick. Good morning, everybody, as well. My name is Torsten Mack. I'm an investment director with Downing. My kind of focus area, is on the healthcare services side, encompassing everything from specialist education to specialist care, as well as some elderly care. Just introducing Downing briefly. Downing is an investment fund manager. We currently manage over 1.5 billion of capital. Our focus is really on the lower mid-market and mid-market, and we focus on growth investing. So really, helping businesses and management teams, or providing them with capital to help businesses and management teams grow their businesses. And I think where we're really unique is that through the mandate of our funds, we are able to provide kind of flexible and bespoke funding solutions, to individual teams, to individual companies. And we're able to invest across the whole capital structure. So do debt and equity. ESG is kind of an important area that we've has become a greater and greater focus for us, and that can be that can very clearly be seen in how we, especially how we engage with our portfolio companies, and helping to educate them about ESG as well. That's me in a nutshell.
Thank you very much, Torsten. Thank you very much. And now let's move on to France. If you would like to introduce yourself, please.
Just turning my video. Good morning, everyone. Yes, my name is France Bourgoin, and I'm Director of Global Sustainability at Leo Pharma. Leo Pharma is a privately owned medical dermatology company based in Denmark. And I am responsible for developing the sustainability strategy and for ESG management. And we just recently signed our first sustainability-linked syndicated loan facility last year. I'll be providing the sort of private sector practitioner's view on ESG in the healthcare sector. I think we can all agree to your introductory statements, Nick, that ESG is really becoming endemic into the world of finance, it has largely privileged carbon and carbon reductions. And I think that we're at a critical juncture in the ESG and finance space if we really want to fulfill the potential of what ESG and investing can actually achieve, especially in our sector. And I think the finance and regulatory push has been really strong in promoting some change in corporate practices. And it would be great to see that same push in the S and in the healthcare sector. So looking forward to the debate today.
Thank you very much, France. And lastly, Jacob, if you would like to introduce yourself.
Certainly. Hi, everyone. My name is Jacob Michaelson. I head up the Sustainable Finance Advisory Unit at Nordea. The Sustainable Finance Advisory team is really the all-encompassing team focusing on sustainable financing, working with clients such as France at Leo Pharma, but also with investors, covering a broad range of discussions within the sustainable finance realm, tangibly on loan and bond discussions, but also more broadly on market-related discussions, taxonomy, regulation and reporting, etc. We've been active in this market for a number of years and obviously are very excited about the development of the sustainability linked market in particular, but also very much around the growing interest in the social aspects of a sustainable world, and clearly see a lot of potential for the healthcare sector to make use of both a sustainability linked and of a social label. So I'm very much looking forward to the conversation today, and thank you for having me.
Yeah, thank you very much, Jacob. And actually, Nordea was the lender to the Leo Pharma on the Leo Pharma deal. So we've got a good range of practitioners from the private equity and the fragmented end of healthcare, all the way up to the larger pharma industries and the lenders and the regulators involved. If you would all join me now, and we'll start the discussion. So please turn on your microphones and cameras. Okay, as I said, we have got a whole gamut, a range of practitioners in healthcare and in finance. But I was interested in what Torsten was saying about how ESG, your ESG is becoming more of a factor when you're engaging with your portfolio companies. Can you explain a little bit more about how that is making an impact in that end of the market?
Very happy to, Nick. I think one of the things that we're observing, especially I think it does tie with us being focused on the lower mid-market and mid-market space. So we're dealing with smaller companies, which in a lot of cases are led by management teams very, very operationally focused. And even though in the healthcare space, they're obviously starting off, I think, as Nick, as you mentioned at the beginning, in a very very good position, because they're socially minded businesses. I think when you look at actually having a comprehensive ESG strategy in place, for a lot of these businesses, there is a learning curve as well, and that's we are engaging with a lot of our portfolio companies on that basis, and some of the kind of key focus areas for us is looking at data collection, collecting the right data to cover off the environmental side of ESG, but also the social side of ESG and the governance side of ESG. And to then translate that into kind of proper reporting, so including something in the board packs that they provide to us, so that we also on our side as an investor have information available that we can then pass on to LPs, retail investors, effectively the pools of capital that we manage. And that is definitely, it's always been an important focus area, but we can definitely see that that the importance is increasing.
Okay, and is the pressure to conform to a greater focus on ESG, is that coming from your LPs? Is that what's driving things? I think
it's really coming from kind of three avenues. I think the LPs and retail investors that we have at Downing are definitely kind of pushing the agenda. But part of it is also us wanting to do the right thing. The whole topic of just responsible investing. I think we all have to do our part. And then a big kind of driver is also looking at exit considerations for us, as we're helping businesses grow. I think from our perspective, if a company doesn't have a comprehensive ESG strategy in place, then it could very well impact on the exit of that business. Either the business, we won't be able to, or we would face significant challenges with an exit, or there would be an impact on valuation. Either are obviously kind of to be avoided. The flip side of that is, I think, what we also fully expect, that if the businesses that businesses do have a kind of a comprehensive ESG strategy in place, that those businesses should actually attract premium valuations as well in the market.
Is that, well, perhaps we'll come back to valuations in a bit, but I just wondered, Deborah, and you're involved in talking to the financiers. How is this move affecting your business?
I think, as I mentioned, we're starting to obviously see two things. We know that funders and investors are looking at ESG credentials more when deciding whether or not to invest in a particular business. And then we're also seeing, more specific provisions come into term sheets. So for example, if it's a term sheet, relating to real estate, that there are requirements relating to the energy efficiency of the real estate that's being funded. We're also seeing, though, quite often that I think it's fair to say there are ESG provisions going into term sheets, but sometimes we're seeing that it's a placeholder going in. As we're seeing more sort of sustainability linked funding, we're seeing sort of placeholders for maybe ESG requirements to be agreed in the future. So, and that's sometimes having an impact on timing of deals, because that's sort of lagging behind the rest of the terms that are agreed for the funding. So certainly, we're trying to encourage clients to think ahead of going out for funding about what their targets are, what strategies they have for achieving those targets, and what processes they can put in place to monitor that and to report on that to investors, because I think that's what's key. Neither the investors nor the organisations themselves want this to become a burden. So it's about thinking in advance as to how that report, how things can be clearly reported on, is in everyone's interest. But I think it's really interesting what Torsten was saying as well about thinking about the exit, because certainly I think, again, this isn't something we're encouraging clients to think about just from a funding perspective, but from having an overall strategy in place anyway, because it's not just funders that are interested in this now. All stakeholders in organisations are interested in this. We're seeing this ourselves at Bevan Brittan. Our workforce, our potential recruits, our clients and potential clients are all really interested now in the impact that we're having as an organisation on the environment and what we're doing from a social responsibility perspective. So it's actually a good idea, not just for the purpose of getting funding deals across the line, but just generally for organisations to be starting to think about having a strategy in place and measuring achievements of milestones within that strategy.
And that's interesting. So it's not just in terms of getting the deals across. Are any deals falling through? Are you seeing deals fall through due to ESG, or is it just, are they being delayed?
I think it's rare for us to see a deal fall through for ESG. There has to be a sort of massive mismatch between an investor's expectations and what can be delivered in order for that to happen. It's more, I think, that we're actually seeing it having perhaps a timing impact because the ESG, the specifics of the ESG requirements haven't perhaps been sort of thoroughly thought through at that term sheet stage in some instances. So we're seeing it as more of a timing impact, but we're not, I don't think it's something that's causing deals to fall through. There's sort of more dialogue between funders and borrowers about this.
Okay, so that's great. And you mentioned in terms of having their targets, and that's very pertinent to what's going on in the debt markets as well, Jacob. If you could give us a quick resume of what's been happening in the green, social, sustainable and sustainability-linked bond markets. They are over to you. I'll leave that in your hands.
Nick, you're setting me up to fail. There's no way you can give a quick overview of that. I'll try my best. Obviously, the market has exploded and then some. This is obviously recognizing that the fundamentals of the market that we are seeing today is really building on all of the work done in the green bond market, which the first green bond was issued back in 2007 and 2008. So we are obviously coming not just from a few years, but on closing in perhaps on 2 decades of really actively working with these types of structures in the market. So certainly we're not in a niche market anymore. We've really gone also full out that we have 2 main structures now that we can work with. Use of proceeds, which obviously is what do you do with the money, and then sustainability linked, which sort of alluding to the conversation just now, is about sort of setting, defining KPIs that are material and then setting targets that are ambitious. And so these 2 structures both complement each other very well, but also allow for different companies to be active in the market. And I think, Nick, that's what you have alluded to a bit and what we'll get into in a few moments, that particularly this sustainability linked structure has seemed quite a relevant structure for the healthcare sector, which at the same time you could use as a way of asking the question, well, why hasn't the social side, the use of proceeds social side, why hasn't that perhaps seen the same momentum in the healthcare sector? So I'll try to answer a bit, but also set up maybe as a bit of a teaser for the rest of the conversation. Clearly, we have seen the growth of that use of proceeds market, which again, very much started from a green perspective. And I think one fundamental aspect to be really mindful about is that although many of the discussions that we are having and many of the concepts seem intuitive and seem like something that we can all get on board with, I think everyone on this call, and in particularly sort of from the legal perspective, there's a big difference in being comfortable about a topic at a high level and then implement it on a practical level. And that's really the big difference that we are now seeing, is that we are actually now at that practical level. And the use of proceeds sector has been a bit difficult for the healthcare sector to really figure out in a social context, because there has perhaps been a little bit of self-risk assessment of, would it be too much to just label our bonds as social? Because then everything we would do is social, and maybe that's not of a high enough hurdle to clear. And I think that's a fundamental nature of the broader aspect around social in this ESG, is that we are really starting now, and we are starting at the outskirts of this to just get a better understanding of how to define things and how to be comfortable with definitions and how to be comfortable with certain claims. So I certainly expect a lot more activity more broadly within the social realm, but also within the healthcare sector in the coming years.
That's great. And as you say, Jacob, I mean, within social, these use of proceeds bonds, they're very project defined, aren't they? So perhaps you could explain a little bit more why sustainability linked structures might be more appropriate to smaller companies, perhaps.
Sure. And maybe let me just clarify one aspect as we touch upon this project thing. The big one practical difference from a green perspective and a social perspective is that in most cases, when we talk about green, it typically relates to a physical asset that does something, whether it's a water pump, whether it's a building, whether it's a windmill or grid or whatever. It's very rare in the social realm to have a physical thing that does something that you can finance in scale, except for maybe hospitals and sort of schools. Except for that, it's the variables at play for social impact to take place are human, they are interaction, they are underground working, and they are complicated like you wouldn't believe it. So they're very difficult to fit into sort of a project box category. So just sort of setting that aside, the reason why we believe the sustainability linked structure in general is a very exciting proposition for smaller companies in general, but also very relevant for social for sort of healthcare companies, is that there's no encumbrance of the proceeds. So you can basically do what we call general corporate purposes funding. And for smaller companies, that general corporate purposes has a lot of value because they do much more sort of networking capital and different fundings all together in the same facilities. Bigger companies have the luxury of splitting out their funding in different streams, depending on what they need to finance. So sustainability-linked structures provide something very exciting for smaller companies. And for healthcare companies as well. Again, we're a little bit challenged with definitions. So what are the real social objectives and how can you quantify that? How can you demonstrate performance on that? But research and development is generally something we've been comfortable with also in the green space for a long time. And really the bread and butter of so many healthcare companies and health-focused companies are research and development. So you can figure out a number of different ways practically to put that into use. But clearly sustainability-linked structures have some very exciting components to it that are relevant for healthcare companies.
Very good. And then we'll move over to France then, because Leo Pharma has done a sustainability-linked loan. What were the targets for the loan? And could you just express from your point of view where you would like to see some of these targets and measurements go? Where do we go from here?
Great. Yes, thank you indeed. I think, sir, as you said, we signed the Sustainability Linked Loan Facility last year, and I'd like to just preface the comments that also Leo Pharma is just at the starting end of its ESG journey. And I think signing this loan was important in many ways. I think part of it is simply where the market is going. The markets are demanding ESG. Secondly, it's been very useful in terms of supporting the development of a lot of the foundational sustainability and ESG practices that we need to have in place. So at the moment, our targets are in the loan are the targets that we have, which are related to our carbon targets, which are science-based and SBTi approved as of just a couple of weeks ago. And they also includes a target on diversity in management. What it doesn't include, which we did have a discussion with Jakob about when we were doing the facility, was there room and scope to have targets around the S that really looks at our corporate performance in ESG, which are those that are tied to our core business activities, which are looking at our impact on health and society and patient health outcomes. Because ultimately, as a pharma company, that is the biggest delta that it is that we can make. We're at a juncture yet that we simply do not have the metrics in place that for us would be relevant to the banks or potential investors, or even to us. And I think that this is a challenge that extends beyond the structures of the sustainability linked finance facilities and really speaks to some of the frameworks and standards that we are working towards. We know that there's been a privilege of the carbon space for a lot of reasons, and we say, yes, it is easier to measure. S, and certainly the health side of S, lacks both granular metrics that can enable us as companies to really focus on something that we know will be comparable and useful to our external stakeholders, but we also lack some of those larger frameworks within which to navigate. So it's not something that we've pushed aside, it's just something that we don't want to set in haste because we want to be sure that those metrics will be relevant to our business and be relevant to the markets in which we operate.
Yeah, fabulous, and that's very true. I mean, we'll come upon. We'll talk again about the structures and the benefits of having in greenhouse gas emissions that you've got measurable targets. But perhaps, France, you could tell us what is, through all of this, what's in it for a company? What's the benefits of going through all of this extra work, all of this extra reporting? What are the benefits for Leo Pharma?
Yeah, I mean, I don't think we need to. There's always this sort of ESG advocates and ESG naysayers discussing on, whether there is a strong financial link and are we doing extra reporting and what are the values. I think, a couple of things. I think as a company, we can't deny that we need to be able to demonstrate that we are able to manage risks that are idiosyncratic to our industry and to our companies. So I think from a corporate hygiene perspective, demonstrating that we have processes and procedures in place and data and evidence to back it up is critical, not only for our external stakeholders and for our owners, but also for our senior management in terms of having a sound management and governance structure. In terms of, the extra reporting, we're at a stage now where we actually have quite advanced statutory requirements in Denmark, so we were doing it anyways. We just now have a system in place that is linked to a part of the business that is more important. So, it hasn't necessarily been such an onerous task. We are improving data collection and data analytics in order to be more efficient. But in that sense, I think from a value perspective of really understanding where is it that we can perhaps find some efficiencies, collecting ESG data and analyzing it is certainly of value. And I think, we also operate in a context, and it is clear that stakeholders, including financial stakeholders, but also political stakeholders, are going to be looking at our corporate performance on these areas. And for us to be credible as a business now and relevant into the future, we need to be able to perform on these basic criteria.
Very good, very good. And just on that, Torsten, what are the benefits for your investee companies from pursuing the ESG, and how are they coping with the social elements of reporting?
So I'll take that kind of one at a time, Nick. Yeah, I think the benefits, as I mentioned earlier, and also kind of tying into what France just said, is we do expect that there will be greater scrutiny by all stakeholders going forward. In the healthcare space, especially healthcare services, these are regulated, highly regulated businesses as well. So it is important to be able to, I think, as France said, to be able to demonstrate that we're kind of doing the right things. And also more, I think one of the key areas is not just being able to be able to kind of report data of what the current situation is, but also to be able to over time demonstrate that there's an improvement, so that be able to demonstrate that we're the portfolio companies that we're supporting are getting better, that outcomes are getting better. I think that's a key element. And then as mentioned, I think our view is that if we're able to support our businesses, or our portfolio companies to demonstrate that there should be a value impact at the end as well. In addition to obviously having a business that is let's say doing more on the ESG front in general.
Thank you. I was just wondering, in terms of the lack of granular metrics on some of these social issues, is that going to be a hindrance to the development of sustainability linked structures? I mean, it's nice and easy, or relatively easy, on the greenhouse gas emissions. We've got science-based measurements. How are we going to improve the metrics on the social elements? Jacob?
Throwing it out there and see if anyone wants to grab the ball. So the challenge, and sometimes I find myself a bit cautious in proposing this, because as we often get told, we have so little time to work with this, but we need patience, time. Zooming out a bit, but as a general reflection on also these points, a lot of the discussions that we're having now, a lot of what's actually happening now in the market is generally around sort of global harmonization in a number of different ways. Also specifically within reporting. Last year we saw some initiative in terms of having more global harmonized reporting platform, the ISSB. We're going to see some templates for that this year, and clearly we have the regulatory aspect both from the companies, CSRD, but also SFDR and a number of other areas where both companies and investors will have to ramp up their reporting on non-financial data. We know that regulators will take a little bit of a lenient hand initially in terms of getting both investors but also companies up to speed and have them sort of get a few reporting periods under their belt, and then on the back of that they might then tighten the screws a bit. And that really is the issue at hand, is that we really needed a bit of patience, because so many companies and so many investors, organizations are now for the first time really fundamentally sitting down and trying to see how they can reshape their reporting schedules. And we need to just give it a bit of time to see how those numbers come in and what we can do to harmonize and what we can use to build on the back of that. we're essentially trying to build a global space for non-financial reporting. And we tried to do that in a couple of years, decade maybe. It's taken more than a century to really build a globally harmonized reporting framework for financial data. And we can always agree on what an EBITDA number is and what a leverage ratio is, but going into the detailed discussions on non-financial data and social discussions. So it is a very different market that we're facing, and we need patience in many aspects.
Patience, indeed. But as you also say, we're running out of time at the same time. There's that dilemma there. And Deborah, is there any regulatory changes that can help accelerate? Also, France, I'll come to you in a second, if that's okay.
Sorry.
Deborah, I just wondered about the regulators, the part they can play.
I think, at the moment, there's sort of no overarching regulatory regime. There's consultations out there, so if you look at the EU, there's a proposal to have a social taxonomy that will sit alongside the existing environmental taxonomy, both of which are aimed at having sort of uniform standards. But that's a way off. And if you look in the UK, there's various consultations around sustainability disclosure requirements. We've recently, earlier this month, had new requirements come in, which only apply though to really sort of large corporate entities and financial institutions, requiring them to make disclosures in line with TCFD requirements. But it's not really so there is regulation coming, but at the moment it only applies to really large organizations, and it's going to take time for the regulations to evolve and to start to apply across the board. But it's not really, from my perspective, I don't see that it's regulation that's really going to drive this. I think, it's the market, and it's the sector, and it's actually collaboration and people sort of talking to each other about not reinventing the wheel. What have we done before? Yes, there's no one size fits all, and different organizations are going to have different targets, especially on the social side, where it is much more difficult to define rather than on the environmental side. But I think it's about organizations getting together across the board, in the way we've seen. So, for example, in the UK social housing sector, a group of banks, investors, housing associations and others formed a working group, and they have a sustainability reporting standard for that sector in the UK that covers 48 different criteria across all elements of ESG, and aims to sort of have a consistent way of reporting on those criteria, which it's a voluntary framework, but a number of investors in that sector have signed up to it. And I think, for this sector, whilst it's much more diverse and again, not one size fits all, I think it's about us working together as a sector. And this is something I'd be very interested in doing, working with others to look at where there can be consistencies, what other people are doing, and in particular on the social side where it's much more difficult. So I think it really is about the market driving it.
I think that collective and improved relationships is key. France, you put up your hand.
Indeed, it was just to complement some of Jakob's comments to your question, Nick, on the lack of granular metrics around the S and sort of ways forward. And I think there's a couple of things I want to touch on, because first of all, the world isn't static, and there is, as I said in my opening statement, I think we're at a critical juncture in this ESG space, and that we really need to pay attention, especially given the regulation that's coming and the consolidation on frameworks that we are seeing, to adequately address the S. I think we all recognize that up until now, there has been a lack of adequate standards for social issues, and that has been challenging for companies to set the right metrics. One of the trade-offs of that is that a lot of the S metrics that we do see tend to be inward looking. So we tend to not look so much of our performance or the impact of our products on communities and on consumers, but it tends to look more inwards into corporate performance around policies. So we tend to see S metrics around issues around diversity, data privacy, and safety. And I think this is really where we're missing an opportunity. And as the trend towards consolidations of rating systems, as a practitioner, is something that is largely welcomed. I mean, we're already starting to hear the alphabet soup between, Deborah and Jacob's comments about the various standards and rating agencies that we have out there. And I think we're all thankful to see increased consolidation and conformity. We also have to bear in mind that until now, neither standard setting bodies or large asset managers have developed approaches to the S that really reliably assess corporate social conduct and corporate social performance. So there's just a slight concern that as we go to this consolidation that's underway, that we're going to, have inadequate standards that are going to be developing, and that we might have consensus around criteria that are slightly flawed. So I think the opportune is really ripe in terms of innovation in this space and really for collaboration. And we sort of have a triad of actors here between the finance space, the standard setting bodies, and industry to really collaborate and to look at, how do we determine what good social practice and impact look like, and then collaborate on the undeniably really challenging task of setting metrics to accompany that. And as Jakob said, it's going to take patience, but we shouldn't wait too long in terms of getting started.
Yeah, and it's not facile either. It's not easy to come up with these standards. And in terms of what I liked about your conversation in terms of the loan with Jacob is all of these targets and all of these things have to be relevant to a company, the company involved. They can't just be, just a standard that you just adopt because it's there. It has to be relevant for each company. Jacob, how do you go about determining what is appropriate for the companies you deal with?
So first and foremost, it's really important to recognize that whenever we are structuring something, whether in the loan market or in the bond market, use of proceeds and sustainability linked, first and foremost, we always start with the underlying principle at play. They're publicly recognized. We've been part of sort of drafting many of them, and that really is what gives us sort of validity in doing this, and in many cases is what I think safeguards us from outright claims of greenwashing. There will always be people sort of picking at the edges and trying to sort of see if you can find an angle of where something might be greenwashing, and I think we're relatively comfortable with that. But structurally, we want to make sure that we very much align with what is accepted in the market, because I think that's really where the more substantial differences can be addressed. So with that said, whether it's a sustainability-linked loan, green bond, or whatever the variations, once we have that as the backdrop, we then very much look at every case on a sort of client-by-client basis. We clearly want to make sure that we align with general market perspectives and investor expectations. But it's also really important to recognize that any type of structure, although we want to set the bar as high as we can, we also want to make sure that we set it just at the perfect spot where the company in question feels like they can actually get on board with that. Because there's no point in setting the bar so high that no one's going to even attempt to jump it. So we need to sort of find that sweet spot where we believe that there's sufficient quality in the claims that we're making, yet the companies that we're working with, that they feel comfortable that they can actually achieve this. Mm-hmm. So there's obviously a little bit of a nuance between then a use of proceeds structure and a sustainability linked structure. In a use of proceeds, it's less about the risks of will I actually achieve this, but it's more about the concerns of do we actually have sufficient projects or assets available. In case they don't, then we just sort of disregard that and say, okay, well, let's look at the sustainability linked structure. And then clearly here we sit down with a company and try to understand who they are. And we will certainly have our expectations. We will certainly have our experience in working with similar clients and looking at various different sectors. But we always try to understand and start from the company's own perspective, because no one will understand and know the company better than the company itself. It is then our job to drill at those points and figure out where we can find common ground on where something is material and when something is ambitious. And what's built into the sustainability linked loan and bond principles is a very clear definitions of the concept of materiality and ambitiousness, but also in a very similar way to the rest of the market, with no clear prescription for how to measure it and how to quantify it. So we can almost always get on board fairly easily with what is material. The question is a bit more around if something is ambitious. And the question is really depending on how far in the journey the company is. And I think that's a really important point to recognize, is that to a certain extent, there are minimum thresholds, but we care just as much about the delta from here to there as we care about the delta from here to there. To a certain extent, we rather want to see that delta take place than this one. So we really try to go in with sort of an open perspective and see what's the company in question, how far in the journey are they, and can we get comfortable with the structure at hand. Then we do see a little bit of structural differences that in the bond market, we tend to focus on fewer KPIs, but more detail and more clarity on that individual KPI. Whereas in the loan market, we tend to have more KPIs. But on the other hand, in the bond market, we only have typically one time where there's sort of a test being made. And otherwise, in between those times, the company can basically do what they want. In the loan market, we have annual tests. So there's a little bit of differences. And we try to make sure we cater to the relevant market. What we see in the loan market is that the number of KPIs being a bit larger means that our approach to materiality is more from this perspective of completeness than detail. So that's why we typically see an E, an S, and sometimes a G KPI combined all together in one facility in the loan market, where in the bond market is much more about a clean focus on E.
Okay. And just in terms of what you said there, Jacob, are you seeing any trends in the markets towards more S and G, or is it still predominantly E?
So it really comes back to what's feasible, because in addition to a KPI being material and a target being ambitious, it also needs to be feasible. You need to be able to monitor the data. The company needs to be able to get data reliably. We have many questions or many cases where we can set a KPI and we can set the targets, but the company says, we are not comfortable in the quality of the data that we are able to provide for this. It tends to be around scope 3 emissions. So sometimes scope 3 emissions are not the full assessments, or they're relying on only sort of partial information. And so in certain cases, the company will tell us we could, but we would prefer not to have scope 3 included for the time, just because we don't have enough quality or confidence in the quality of the data. And obviously, as a bank, if it's a loan, we appreciate the feedback that the company has a certain minimum threshold of quality. And so that's why we tend to look at other KPIs what we can work with. And so I'd say it's less about a preference for E, S, and G. It's more about the total combination of what meets materiality and ambitiousness, but also what's feasible. But I will say that quite often we are able to get at least one KPI focused on CO2 emissions, typically scope 1 and 2 emissions. Maybe we also have a scope 3. There could be other KPIs related to sort of environment, whether it be water management, it could be waste. We do also now see, I hesitate a little bit on calling it a social KPI, but for lack of time to sort of go into further details, you could call gender equality a social KPI. And in which case we do see more and more companies including a social KPI in that sense, whether it's on gender representation. For the new ones, we phrase it as representation of the balance of the unrepresented gender, because it's really important to recognize that although in most cases it will be fewer females than males, we are to a certain extent agnostic. One of the reasons that we target gender equality is for the fairness of treating everyone equal, but it's also from the perspective that we want diverse teams. Diverse teams make better and better risk assessed decisions. So an all-female management team has just as much risk than an all-male management team. So if it was that the male portion would be underrepresented, it would similarly be on that part of it that we would look. So we always have the nuance of focusing as the unrepresented gender, and then we can obviously set the thresholds around 40 to 60, or in certain cases 45, 55.
Very good, very good. And that's interesting because that's one of the ones that were on your sustainability linked loan, weren't they? France was gender equality. But I was just wondering how this feeds down through into the smaller companies. Is that something you're seeing in your investee companies, Torsten?
In which sense, Nick? You mean in terms of just reporting and KPIs and?
Well, I was just interested in the gender equality. Is that something that interests the firms there? Is something that's something you're asking about?
Yeah, I think absolutely. I think whether it's a big company or a small company, you know, I think the focus areas and the criteria are actually not that dissimilar. You know, I think the starting point is very different. I think, as Jacob just said, I think one of the risks is that as an investor, you kind of go in and you inundate, you know, companies with information requests and data collection requirements and so forth that the company is not, you know, possibly not in a position to deal with given its size. You know, I think it's very important, as we do with all businesses, is of really engaging with the companies, with the management teams, you know, and developing a strategy of what, you know, where do we want to kind of end up, you know, and how do we get there, and really engage with them of what are you able to do, you know, to kind of, you know, meet the ESG requirements, you know, because Downing actually is in a advantageous position of investing in a number of different, you know, healthcare subsectors, you know, for example, specialist education, specialist care. You know, if you're focusing on the social aspects, you will probably look at very different metrics and very different KPIs. And one of the key things that we spend time with our portfolio, you know, companies is really, you know, trying to come up with, you know, constructive and pragmatic ways of collecting kind of relevant data and data points around outcomes, quality, which we view as one of you know, some of the kind of the core elements of that social aspect, you know. And you know, should probably also mention, I think where private equity can kind of differentiate itself as well is by having an in-house ESG function. We have a head of ESG within Downing, you know, who's not just there for, you know, for Downing, but he's also there to, you know, help us engage with our portfolio companies, help us advise them of how to potentially, you know, tackle certain aspects, you know. And I think that's very important. We actually view, you know, on kind of at the smaller company end as well, as we view this all as an opportunity, you know, for value creation as well, of working with kind of smaller businesses to kind of get them up the learning curve.
Fantastic. Okay, we're running out of time, so I thought I'd just ask a few questions from the audience. One of which is, what strategies would be most appropriate to implement in ESG for emerging market healthcare sector? Any thoughts on that, France? Do you have emerging market ambitions?
Yeah, but I think that's a challenging one as well. I think right now where Leo Pharma is operating, we're not having a huge focus on emerging markets right now, but I'll take it from a generic perspective in terms of the healthcare sector. I think this is where the change and the development in the S standards and frameworks are going to be critically important. Because I do think that those questions around accessibility and patient impacts are going to be critically important to the healthcare sector, also in emerging markets. And in order to that, the debates have really evolved to what was there in the past and what was largely set out by the Access to Medicines Index. I think we also have an opportunity to look at an ESG strategy in terms of how our value chains and especially our supply chains are structured, and looking at perhaps having a sort of bespoke ESG strategy in terms of where it is that we are producing, what are those relationships with those emerging markets, in order to maintain that materiality, as Jakob has alluded to, is going to be critically important. So I would see it, you know, taking that sort of bifurcated approach in terms of, you know, where's your operational footprint, what does accessibility look like, and there is a space there that is really ripe for innovation in terms of how we look at that, and also look at the operational footprint and looking at improvements and moving the needle and the direction of change in your supply chain.
And I think the healthcare sector is uniquely placed to make some impact in the emerging markets. And we've seen a couple of bonds recently from Sanofi and from